Welcome to Lithium-ion Rocks, episode 24, Growing Up, Piedmont Lithium. Piedmont's listed on NASDAQ as well as the ASX, ticker symbol PLL, market cap about $60 million US. They have no debt, no offtake partners, pretty clean capital structure, but have hit a number of milestones this year, as we'll discuss right now. It is Thursday, December 5th. I am in the offices of Piedmont Lithium in New York with the boss, Keith Phillips, who it's the second time we've interviewed Keith. He was here in April. A lot has happened since then. He raised some money with some of the best institutions in the world, some $21 million with Fidelity, taking a 9% position, and an existing shareholder, Oz Superannuation, one of the biggest pension funds or mutual funds in Australia, maintaining their stake. I think it's now around 13%. Since then, they have announced an enlarged resource, enlarged mine life, some 25 or 27 years. They've also announced a byproduct marketing agreement for their feldspar and quartz with a world-class private equity group, AMCI. They have been permitted for their mine and concentrator 11 months after they started that process with the Army Corps of Engineers. And then last week, they announced a appointment of Hatch, the most experienced, chemical plant advisor to assist with their pre-feasibility study and definitive feasibility study. So the target, Piedmont, unlike many other companies who have delayed their plans, actually brought forward their plan to produce lithium hydroxide by a year or two, and now they're expecting that by 2023. It's a vertically integrated, plain vanilla hard rock to hydroxide strategy that is expected in the first half to complete the pre-feasibility study, and by this time next year, in some 12 months, they expect to be permitted and have a definitive feasibility study for the vertically integrated strategy, and subject to financing, could be in construction in the beginning part of 2021. Today, it was announced that LG Chem and GM are putting together a $2.3 billion battery plant in the Lordstown, Michigan plant. That is, I think, a 30 gigawatt plant. I saw Sam Jaffe, a very astute battery analyst, mention that $2.3 billion is about half of Tesla's investment in the Gigafactory in Nevada for something of similar size. I think Tesla's is 35. So it just demonstrates how cost of battery plants and manufacturing have come down. Bloomberg New Energy Finance earlier this week came out with their numbers that showed yet again a 13% decline year on year in battery pack cost. So the trajectory of the industry is very strong. Earlier this year, Volkswagen put out what we call their manifesto, and talked about the sustainability aspect and the hard rock to hydroxide being their preferred route, and preferably close to production. Volkswagen has announced in Chattanooga, Tennessee, just a couple hundred miles from Piedmont, that's going to be the center for their MEB and ID3 production. The GM plant with LG Chem apparently was, they talked about making Cadillacs and a couple of trucks and SUVs. And as we've talked about Piedmont being, and my friend here, Keith, who I've known for 15 years, being in New Jersey. I'm from Long Island, so there was always this competition between Billy Joel and Bruce Springsteen. But as is my want and affinity to create narratives and nicknames, the boss, Keith Phillips, we had a Born in the USA, Born to Run moniker earlier this year. I now think, maybe pink Cadillac for those GM cars, and Growing Up from the first Greetings from Asbury Park, as well as She's the One, are going to be the background music for this interview. So that's a very long introduction. I have Keith here now. I guess I just want to start. Keith became CEO about 2.5 years ago. Piedmont at that time had backed into a shell company in Australia. It had 500 acres, 19 drill holes, and that's about it. It is now listed on NASDAQ. Keith, for the first time, left his very long, storied career on Wall Street, some 30 years as an investment banker, M&A, knew nothing about lithium, until I kind of introduced him to the concept, and after 4 months of diligence, decided that lithium looked interesting, and this asset had significant kind of strategic value. Is the story today, 2.5 years in, I guess, is it as good, worse, better? What are some takeaways, surprises on the upside, downside?
Been a lot of positive surprises. Our asset is bigger than we thought it would be. The grade is higher than we thought it might be, and the economics are better than we thought they might be. So the project we have within this business is that much more attractive than we thought it might be, which is terrific. It's, as you said, a 25-year project, 22,700 tons a year of lithium hydroxide at around $3,100 cash cost net of byproducts. That would be the lowest cost producer in the world. We're confident that directionally those numbers will hold up in the PFS and DFS. It's just that we're very fortunate to be in an amazing environment in North Carolina. The one negative surprise, it's been interesting to see the strong growth in EV kind of adoption by the major OEMs and development, and you look out 2, 4, 6, 8 years, it's really, really exciting. It's been surprising to see the short-term downdraft based on the oversupply issues we faced really coming out of Australia in the last year or so, which are clearly having a big impact, but I think will be temporary. So I think I share a view of most people in the industry where I'm surprised prices are where they are today. I expect them to be far stronger in the medium term. Surprised where stock prices are for a lot of companies today. I expect those also to be far stronger in the medium term. But long story short, after 30 months in the job, very happy where I am, very excited about our unique project, and really bullish about the long-term fundamentals for the space.
It's the end of the year, so kind of taking stock of what happened this year and looking forward to next year. So there was a marked shift in the middle of the year when the subsidies were reduced in China. And everyone talks about the oversupply, from out of Western Australia, but not enough people, I think, talk about also the Shanghai brines. We were both at the Cathodes conference, and General Lithium put up there that was like 40,000 tons of not great quality, but nevertheless competing with SQM's low quality into China and Orocobre's and some of that. Although that 40,000 number, maybe 30,000 I heard from Anthony C. So there's a little bit confusion on that, but the demand definitely slowed in China, and that's obviously impacted. However, if I look at Neo Metals this time last year sold their 14% stake to their partners, Ganfeng and Mineral Resources. That's a vertically integrated. One was only spodumene, so they paid 104 million Aussie. If you do the math, it was about 515 million US just for a spodumene minority stake. Although it did give them implicit joint control of that asset. Although Neo Metals retains, I think, some 70,000 tons, so there's some value there. But in any event. That's a reasonable price as a vertically integrated, from Ganfeng's perspective, that is very much a vertically integrated spodumene to both carbonate and hydroxide, relatively rich valuation. Then you had this time last year, Albemarle, obviously with their $1.2 billion, which they increased to $1.3 billion, although they restructured that joint venture a bit. But they had every opportunity to walk away from that deal in the middle of this year, but did not. Likewise, West Farmers with Kidman paid essentially $525 million just for that asset, and they've increased the CapEx, I think, to $700 million Australian dollars just for their take. So that's like $1.1 billion US investment in Kidman for a project for their half share is only about 23,000 tons. I say only, but that's the equivalent size of the Piedmont Lithium project. So you're sitting here at a 60 million US market cap, and you have these three data points of real strategics understanding the hard rock to hydroxide vertically integrated strategy. That to me demonstrates, the value of these assets.
I think what's clear is smart money understands the long-term strategic opportunity. We're at, give or take, 2% EV penetration right now. That number is going to rise very dramatically. I think, frankly, some of the longer-term estimates will prove to be conservative. And I think people understand this is a very exciting opportunity, and there happens to be a real valuation opportunity for investors now with the relatively short-term sort of dislocations. We have the only American spodumene project, so it's interesting. The three transactions you spoke about were spodumene-based. So having a spodumene-based integrated business on private land in North Carolina is very interesting. It's the only, again, American spodumene project. It's the only American greenfield hydroxide project. And it's in the eastern U.S. on private land with a federal permit for our mining operation. So we feel exceptionally good about our strategic position, and I think we're confident to the extent we're interested in partnering or having strategic conversations that others will see our assets similarly, and some of those conversations are ongoing. In terms of developing the project a year from now, if a year from now the market's where it is today, we'll have a difficult decision to make as to whether we want to accept the financial dilution that would be required for shareholders to kind of fund the project in that environment. And that's why you've seen so many other projects slow down. That would be a difficult decision. I frankly don't expect the market to be this way a year from now. I think prices could be considerably higher. I think equities could be considerably higher, including ours. I think with the de-risking of the activities we've had, I think there's a chance the stock completely re-rates. And it's quite possible there will be strategic interest develop as well. And we haven't talked about offtake yet, but we've had a lot of conversations with a lot of the important players in the battery supply chain. And I think those could be important announcements for us as well. So financing a project like this, I think the economics are very strong. It's in the ideal location. There's literally not a better location to be doing what we want to do. So I think the financing will take care of itself. I really don't worry about that.
Share with us, I guess, some of the feedback from some of the Asian, and European OEMs, battery companies, and cathode that you've been meeting. You've been to Asia like 4 times this year, I think.
The basic feedback, I guess, is number one, on the hydroxide versus carbonate front. This is it's a really important point, and the comment that was made by General Lithium at the Cathodes Conference was interesting, where they projected that lithium hydroxide demand would exceed carbonate demand by 2022. That's something I've never seen anyone else project. And when I asked a question about that, the feedback was, when you speak to the customers, the cathode guys, the battery guys, the car companies, all they want is hydroxide. Hydroxide is required in high nickel chemistry batteries. High nickel chemistry cathode drives range and energy density. So everybody, whether it's Tesla or Ford or Volkswagen or others, are working to really expand range, use more nickel in their cathode. That requires hydroxide. It's great for hydroxide. We believe we'll be a low-cost producer of hydroxide. So that's a really important thing. And the reason we accelerated our chemical plant development, you had mentioned that earlier, was really in reaction to meetings with several of the major players in the supply chain, where it became obvious that it became clear to us, they were transparent with us. The cathode and battery companies have made commitments to these large OEMs to supply them batteries by certain times. And they require, obviously, lithium to make those batteries. And those commitments aren't very far away, and they're dramatically larger than, say, 2018 or 2019 production for everyone we're speaking to. So there's a really long need. And if you work back from 2023, for instance, we actually hope to be in production by the end of 2022. But really, you need to begin construction at this beginning of 2021 to do that, and that's the timeline we have. And that's been driven by customer interest and customer encouragement to move more quickly if we can, and so we are. So I think net hydroxide demand is going to grow very, very strongly. We intend to, over the course of the next year, put in place 2 or 3 or 4 very strong offtake agreements with blue chip customers across the supply chain, with a real focus on the United States EV market and secondarily the European EV market, where obviously that market's leaving Tesla aside, Europe is moving more quickly than the U.S. is to electrification. We're a lot closer to Europe than China is, so we're a potentially very attractive source of supply into that market. That's something we're speaking to the customers about as well. And so I think it's interesting. You've really got a tale of two markets. You've got the current spot lithium market. You've got lithium equity prices, both of which are depressed for understandable reasons. But in the background, you have this demand for battery quality lithium hydroxide building in great scale with really highly credible groups that have made commitments to other highly credible groups, battery companies to car companies, in the medium term. So 2023 is not that far away, and I think there's a point in time, which I think will come in 2020, where the market's going to sort of wake up to this reality, particularly for those developing hydroxide projects, and we'll have a really sharp reaction in the price and in the equity prices.
For a small company, I think we have, 6 analysts covering you. I think the target prices generally, Red Spencer, I think, is at 30 cents, and Taylor Collison and Roth Capital and a few others. I guess just your approach to building profile and in the Australian market and in the U.S. market. How do you see that evolving? And the liquidity is not great yet, on the Nasdaq, but just talk about your strategy for the company in that regard, to date and over the next year.
Sure. So we're we have an American asset. We have an American management team. We're actually an Australian corporate entity, but we decided to list on Nasdaq. And I think based on my experience with dozens and dozens of clients, generally out of Canada, quality companies that list in the U.S. tend to find most of their trading volume migrates to the U.S. for one very simple reason. It's just a dramatically larger capital market than the Canadian market or the Australian market. So I've had good experience myself in the past in the Canadian market. Our company has done really well in the Australian capital market. That's important to us. You mentioned AusSuper and Fidelity in our stock over there. We also have a number of other really high-quality institutions in our stock and a number of high-quality retail investors. So that's an important market for us. But there are 50 or 60 lithium companies listed in Australia. There are 5 listed in the United States. So this capital market's probably 10 or 15 times the size of the Australian market. There's far less for American investors to choose from in lithium. 3 of the listed stories are majors: Albemarle, SQM, and Livent. Then there are Lithium Americas and ourselves as the 2 kind of developers. And I think it's an educational process of really getting the word out. Livent went public, a year and a half ago. That was the first pure-play lithium company producer ever listed in the United States. And so it's a new sector. It's a new sector for the investors. It's a new sector for the analysts to really get their arms around. It's evolving very quickly. But at the end of the day, if we can develop real liquidity in the U.S., that will mean more demand for our stock. By definition, that'll mean a higher stock price. So it's an important objective for us. We did file a shelf registration with the SEC a few months back. That is now effective. We don't need any money. You mentioned the $21 million deal we did in July with AusSuper and Fidelity and others. So we're very well capitalized now. We don't need money. But the time will come where we'll do a proper U.S. public offering and offer the shares more broadly here than we've been able to do before. That will be a big liquidity event, just the deal itself, but also the trading liquidity that will follow that. So that's a strategic objective for us. We'd like to see more and more of our stock trade here. And we think it's an important differentiating factor for American investors who tend to be, from an investor perspective, fairly provincial. They want to buy stock through their Merrill Lynch or Schwab account. They don't really want to trade on foreign exchanges, and we've positioned ourselves very attractively for them.
If we could talk a little bit about, there's Ioneer, there's Lithium Americas, Thacker Pass. It's hard, because it's embedded within a company that's advancing an Argentine project. But when I look at the landscape, and we had James Calloway on the show earlier this year, and he spoke at the Benchmark event in Washington, he kind of laid out the universe of American opportunities. And he said, basically, you have plain vanilla, spodumene like Western Australia, but it's localized in the Carolina tin spodumene belt, right? Then you have, clays like Thacker Pass. You have unconventional brines like Standard Lithium, which is making very good progress, and then you have their project, which is kind of boron and lithium. And they raised an enormous amount of money, well-timed, a year and a half ago, 2 years ago, like $600 million market cap. But they just raised another $40 million at a $225 million market cap. And you're raising money at, it's great institutions, only about a $50 million market cap. So what do you think, like, in my opinion, a plain vanilla hard rock, where Albemarle and Livent have hydroxide, I'm calling this the Hydroxide Hub in North Carolina. I mean, this is where, outside of China, this is where all the hydroxide is being produced. And it is, very familiar, historically from 40 years ago production, but also just known. You've appointed Primero, you've appointed Hatch. I mean, the skills to, produce lithium from the rock that exists in North Carolina is, right up the fairway of anything that one would, look to. But, Ioneer, has had this like very significant market cap, and more power to them. I think it's a good project. I mean, Rodney has written about it as he's written about you. We believe in that project. That project is, very well may be undervalued as well. But, at a $225 million market cap, it's not 4 times better than Piedmont, in my opinion, or 4 times more likely. So what do you think? How do you think about that, right, in the context? I mean, I think about it as asymmetric risk in, if you do your work in microcap, not well understood markets. But I guess, how do you respond to that?
Good question. Something I get asked a fair amount. I think, first of all, the folks at Ioneer, at Standard Lithium, at Lithium Americas, and many other companies, great people, some really interesting projects. I don't know a lot about them. I don't know a lot about their issues. I guess it's fair to say every project has its particular attributes and investment considerations. Every project has the potential drawbacks or fatal flaws people worry about. For us, one of the things people worried about was permitting. Could you permit a project 30 miles west of Charlotte? And, we have other permits still to get, but getting our federal Section 404 permit is a huge landmark event. We had a high degree of confidence we'd get it on the timeline we did. That's been accomplished. That's great. We feel very good about the air permit we'll need for the chemical plant, et cetera. We believe that'll happen in 2020. So it's really important to understand each of these projects. I think one important thing for us is our company's relatively young. So Ioneer, Lithium Americas, Nemaska, you've mentioned, Kidman, you've mentioned, the Pilbaras, the Galaxies. They were all around in 2016, 2017 in the last kind of boom market for lithium. We declared our maiden resource in June of 2018, so the market was already falling hard. We've been in a situation where we've delivered good news, generally positive surprises from a resource perspective, a metallurgy perspective, a engineering and cost perspective, permitting perspective, and frankly, we've just been in a market where people have been selling lithium equities, not buying them. So we're really looking forward to the next turnaround. We think our stock we do think we're undervalued relative to many other lithium producers or lithium developers. We think we're massively undervalued relative to a few. I'm confident that'll take care of itself over time. I think Fidelity and AuSuper and some other institutions kind of see that as well. But to be honest, we're in a market right now, and this is why they say it's always darkest before dawn. It's hard to get people to focus on lithium equities right now. It's a new business. People don't have a lot of knowledge of the business like they do coal or copper or nickel or gold, where they've been looking at it for a very long time. People are really uncomfortable with the supply-demand issues, the pricing issues today, and they don't really know when it's going to turn, and that's fair. And I don't know when it's going to turn either, but I know for sure it's going to turn, and it's going to turn because every car company in the world is racing into the EV space. They're all going to need batteries. Lithium is the dominant technology, and as a general matter, they're chasing hydroxide. So I have a high degree of confidence things will change. When they do, I think we'll be a primary beneficiary. It has been painful to raise equity at levels that we think are below our true valuation, but that's kind of the cost of advancing the project. So I guess that's all I'll say. I mean, and I think, again, I think the world of a lot of these other people and their projects, and I think the core advantages of ours, we're in North Carolina, we're on private land, we're more advanced in the permitting process than most. We'll be ultra low cost because we're where we are, and we're entirely conventional. Mining's a risky business. The chemical business is a risky business. even executing a conventional project has risks, but not having to worry about breaking new ground is very appealing from my perspective as CEO.
Could you talk a little bit about sustainability? Because there's, as direct lithium extraction stories are getting a little bit of traction and clay stories are getting traction, like sustainability has become one very important, but I think lithium in particular, even though the carbon footprint of any lithium project is relatively small to say a nickel project or a copper project, but it seems to be held to like a higher standard.
The issue of sustainability is critical. It's very important. That was made clear to me in conversations with one of the biggest OEMs in the world when it was front and center of their discussion. Issues, transportation distances, what sources of energy will you use, et cetera. The good news is it's really good for our project. So right now, a typical lithium molecule, as Sam Jaffe would say, would travel from South America, say, into North Carolina to be put into be upgraded to hydroxide, then shipped to Japan or Korea to go into cathode material and a battery, and then shipped perhaps to Nevada to go into the battery plant, the gigafactory of Tesla, and then into California. So it's sort of a 25,000-mile trip. Imagine a scenario where we produce lithium hydroxide in North Carolina and on our site and ship it, an hour away or less to a cathode plant, which then goes an hour further into a battery plant, and then maybe an hour to some car plant. And that's very important for the car company and for the big battery companies, the LGs of the world, who are these are major corporations who are very concerned about these things. And it's very good for us. I mean, it's great that it's sustainable environmentally, but it's also less expensive and lower cost, and that's important. So it's commercially very sustainable. Big advantage for us that our chemical plant's about 12 miles away.
So you defined a 25-year mine life, which is basically just a subject of like you're having acquired land and drilled out certain portions of it. But the USGS, I think, estimated there's some 750 million tons across the whole belt. We had Luke Kassam on the podcast earlier this year saying that Kings Mountain is greater than 20,000 tons for 20 years.
Carolina tin spodumene belt is huge. There was an article in an Australian technical magazine earlier this year that identified it as one of the three big belts in the world, alongside Greenbushes and Monono in the DRC. So it's a massive belt, 750 million tons. Maybe 50 million tons was mined previously. So there's clearly a lot more there. We're the biggest landholder now. We have 27.9 million tons of resources. Virtually every drill hole we've executed has hit high-grade mineralization. There's an awful lot of the belt we certainly don't control and haven't drilled. And so I think the opportunity is quite vast. Making it a lot bigger, we think, is something that's viable. But an opportunity that I think exists is to really, you think about all the spodumene in the world, from Australia, from places like Canada, Brazil, parts of Europe, parts of Africa. Right now, the only place to sell that material is into China. There's a handful or so of high-quality converters in China. Everyone in the downstream business, in the battery business, and in the car business is looking for sources of supply outside of China. They understand that China will be a large component of the business forever. That's great. But people look like diverse sources of supply. So, the opportunity to grow our business by converting other people's spodumene in North Carolina is something that we think is actually interesting. It's something we'll be studying next year.
That's interesting. I mean, a company like Sigma in Brazil, theoretically could, instead of, I think their plan is just to ship to China, because right now the only conversion in the world is in China. But if they were to ship to North Carolina, for example, if they don't build their own, downstream in Brazil, then that could be servicing the U.S. market. It could also be servicing the European market. Failures, let's say, or difficulties. I view those failures to some degree a function of capital markets, kind of dysfunction, meaning it's hard to finance and properly, get a business into production which takes like 4 or 5 years if the capital markets are open and closed within 2 years, right? So Galaxy and I guess the RB Energy and, all sorts of reasons, in Nemaska, have had the operational difficulties are not for juniors alone. I mean, Tangxi has had a big cost overrun in Kwinana. So I view there's an element, there's a sentiment in the industry that a junior can't, develop a project on its own, right? It has to have, some sort of partner. And if you have to have some sort of partner, then the partner has a lot of, cards to play in terms of, valuation.
We're totally focused on shareholder value and kind of risk reward. So if we have the opportunity to work with a very strong partner like Kidman did in bringing in SQM, like Minres chose to do with Albemarle, of course we'd be open-minded to that. And they have great expertise, they have access to capital, they have customer bases, et cetera. But I don't think we need it. And I will say there are other companies that aren't currently in the lithium business who have expressed real interest in the lithium business. It's very, very rare to find a business that's relatively green. It's a green mining operation, essentially, where demand is growing, expected to grow 20-30% a year for a couple decades. It's very unique. That doesn't happen in copper or in coal or in a lot of businesses. So people are looking to get into it. There are a lot of people in the chemical industry who look at lithium and understand its complexity, but they don't view it as rocket science. So I think there's an understanding perpetuated by the majors for their own selfish interest. I think that gee, this is really, really, really hard to do. The only people that can do it are the 4 or 5 of us that are doing it now. I don't think that's true. And I think when you look back in 10 years, there'll be a number of people who demonstrated the capability to produce these materials. And some of them will be new entrants. When you see West Farmers coming into Kidman, they're a big company. They have a lot of expertise. I'm sure they'll learn a lot about lithium and then they'll develop more expertise. I think wouldn't rule out others of that ilk that no one's ever heard of before in a lithium context coming into the business and playing an important role.
I agree with you, and I would also take the flip side on the Kidman because SQM really doesn't have much hard rock experience. I mean, I know they talk about their caliche ore for iodine, but the reality is that SQM is not a major player in battery quality hydroxide, right, which is the plan at Kidman. And nor is West Farmers, right? So the biggest chemical companies in the world are actually oil companies in America, and there's clearly plenty of West Farmers-like companies in America that see, an opportunity here. I saw in Lithium America's case, their contractor, North American Coal, is a coal company, right? So here's an opportunity to use coal expertise, for clay. I'm not actually fully sure, how similar those things are, but in any event, it's a coal company getting and diversifying into an industry of the future. So I think that there are lots of companies in America, right, that are starting to understand, this industry. So they could be your partners, I guess, or acquirers. But at the same time, again, because of in the lithium industry, hard rock to hydroxide it's a young industry, and yes, things are hard, but that's the thing that's been done the most. Like Primero, your contractor has done more plants, than anybody, Hatch as well. And then there are other people, there are the individuals, right? I know Lithium America has hired a lot of people from FMC. There are various people who have expertise that you could hire to build it, I would think. And especially in North Carolina, it's filled with chemical engineers and the like.
North Carolina is the cradle of the lithium business. It all started there. There's probably more English-speaking lithium processing talent within 15 miles of our site than anywhere else in the world. So, building a team is something we'll be focused on in the first half of next year, and that's an important opportunity. The other thing I would say is, it's a business where the people who need the batteries are the car companies. Those are big companies. They're 20, 50, $100 billion companies who really are highly motivated to make sure their suppliers of batteries, LG, SK Innovation, Panasonic, et cetera, can deliver the right quality batteries. Then you go down to the cathode producers, the lithium producers. There's an immense amount of expertise in the supply chain. Those folks are highly motivated to help people like us develop a product that works for their supply chain, and those are conversations we're having now. As a general matter, if you assume a producing company, a steady state producer, would trade at, say, 1 times NAV. When a project's de-risked, people pay more for it. We've had some really important de-risking events. The first was really making the business big enough for people to care. So we believe we've done that with 25-year mine life, 22,000 tons a year of lithium hydroxide, ultra low cost. The federal 404 permit for the mine and concentrate plant, huge de-risking event, and then working toward bankable feasibility study by the end of the year with all the permits in place. The business is just worth more. It's closer to cash flow. People can have a higher degree of confidence in it. But as a general matter, the market's going to rebound strongly. I'm confident. I personally have no personal doubt about that. I think when that happens, the big guys are going to be looking for consolidation opportunities, ways to position themselves strategically. One thing they'll look at is for assets in unique places, conventional, high-quality assets in interesting places. We have the only asset of that kind in the United States. It will have very high strategic value for somebody someday. And our job is to position this company as being attractive to the most broad group of possible investors, including those in the public market in Australia, in the U.S., and elsewhere, and in the strategic world with private equity folks and offtake partners and potential strategic partners, et cetera. Imagine a world where in, say, 2024 or 25, we're producing 22,700 tons of hydroxide, and prices are at the levels Roskill's projected, which is the deck that we've used and a lot of others have used in our models, and we're generating $300 million of EBITDA, and we have a 20-plus year life. It's a highly strategic asset, and there's an opportunity to grow that by getting more land, drilling more, maybe converting some other people with material. You could grow those numbers dramatically. You could imagine and you can envision, and I do, a very, very significant value in a business like that. That's a multi-billion-dollar public entity.
This time last